We will be talking about SMSF lending structure. The first step to purchasing a property in a self-managed super fund is to set up a fund with a correct investment strategy in place. A self-managed super fund itself cannot borrow any money from a bank. However, under a limited resources borrowing arrangement, a bear trust structure is put in place to facilitate the transactions. The bear trust and a corporate trustee are merely legal entity, and their only purpose is to keep the title over the investment property until the loan is repaid, at which time the legal ownership of the property will revert back to the self-managed super fund. Fund can be borrowed from the bank via limited resource loan, meaning the bank does not have resource to the self-managed super fund. Should the loan default for this reason, bank usually asks for a personal guarantee from the trustee or the directors of the trustee company. All the rent received from the property is paid to the self-managed super fund, and the self-managed super fund is also responsible for making the repayment of the loan. In this section, we will be discussing the self-managed super fund lending transactions. So now you understand the structure of borrowing through the self-managed super fund. Let's talk about parties involved in the self-managed super fund borrowing transactions and how the transaction works. There are four main parties to the transaction: a financial planner, an accountant, a solicitor, and a mortgage broker. Before a self-managed super fund is established, the client needs to sit down with a financial advisor and discuss whether setting up and purchasing property through a self-managed super fund, SMSF, is a desired strategy for them or not. If this is the case, then the financial advisors put together the statement of advice outlining the strategy. The client then speaks to their accountant, who advised on the structure and operation of the fund. The accountant will then set up the self-managed super fund and prepare the bear trust and other structures. The solicitor prepares the legal documents required to set up the self-managed super fund, and this is generally as per as accountant's instructions. Once the self-managed super fund is established, the mortgage broker can then put together a pre-approval to obtain a finance for the purchase. As a general rule, here are the documents that needs to supply along with the application: a copy of the self-managed super fund trust deed and a copy of the security custodian or bear trust deed. Now, if the fund is already operational, you may be required to also supply financial reports, the self-managed super fund annual return, and an income tax return for newly established fund. Evidence of the ability to meet the superannuation contribution will need to be demonstrated through a personal tax return and possibly payslips as well. Once a suitable property has been found, the bear trust structure can be completed and the finance unconditionally approved. And after settlement, the rent received for the property and the repayment for the loan will then filter through the newly established self-managed super fund bank account. Important points: all members of SMSF must also be trustees of the fund or directors of the corporate trustee. Number 2, resi properties cannot be leased or rented by a member of the SMSF or relatives, but commercial properties are different, like a clinic or for medical professionals. Number 3, negative gears SMSF investment cannot be offset against the PAYG income of the SMSF member. And number 4, SMSF cannot have access to the equity. And number 5, and last one, members cannot sell property to SMSF. In this part, we will cover the 5 common mistakes people do when they purchase property through their self-managed super fund. Number 1, people sign a contract to purchase a property before they seek advice or have a correct structure or pre-approval in place. Number 2, exchanging contracts in the wrong name, so using the self-managed super fund or their own name instead of a bear trust. Number 3, trying to purchase with little or no deposit. Many people don't understand that the self-managed super fund needs to have accessible cash fund that can be used as a deposit. Number 4, properties that are purchased with either multiple title or a separate title. So this could be a block of strata title units or, for example, a unit with a car space that is on a separate title. In this instance, separate bear trust needs to be set up for each separate title. People thinking that they can purchase properties and make improvements like renovation to it to increase the value. Please note that owning property and making an improvement to it are fine for a self-managed super fund that owns the property outright. If there are borrowed monies involved, the rules change and they will need to seek clarification with your accountant. So as you can see, there are many common mistakes that people make, and you need to make sure that receive the right advice from authorized people before entering into purchasing properties through a self-managed super fund.